Okay, the biggest force behind the startup bubble in the United States has been SoftBank Group, the Japanese publicly traded conglomerate. It has been the biggest force in driving up valuations of money-losing cash burn machines to absurd levels. It has been the biggest force in flooding Silicon Valley, San Francisco, and many other startup hotspots with a tsunami of money from around the world, money that it borrowed and money that other large investors committed to SoftBank's investment fund to ride on its coattails. But the scheme has run into trouble, and a lot is at stake. I'm Wolf Richter, the publisher of WOLFSTREET.com, and you're listening to the Wolf Street Report. It's Sunday, October 6, 2019. The thing is, SoftBank Group has nearly $100 billion in debt on a consolidated basis as a result of its aggressive acquisition binge in Japan, in the United States, and elsewhere. This includes permanently broke Sprint Nextel, which is now trying to merge with T-Mobile. It includes British chip designer ARM that it acquired in 2016 for $32 billion, its largest acquisition ever. It includes Fortress Investment Group that it acquired in 2017 for $3.3 billion. In August 2017, it acquired a 21% stake in India's largest e-commerce company, Flipkart, for $2.5 billion, that it sold to Walmart in less than a year for what was said to be a 60% profit, and on and on. In May 2017, SoftBank partnered with Saudi Arabia's public investment fund to create the Vision Fund, which has obtained $97 billion in funding. Well, not actual funding, some actual funding, but a lot of promised funding, which made it the largest private venture capital fund ever. The Saudi Public Investment Fund promised to contribute $45 billion over the next few years. SoftBank promised to contribute $28 billion. Abu Dhabi's Mubadala Investment promised to contribute $15 billion. Apple, Qualcomm, Foxconn, Sharp, and others also promised to contribute small amounts. Over the past 2 years, the Vision Fund has invested in over 80 companies, including WeWork, Uber, and Slack. But the Vision Fund needs cash on a constant basis because some of its investors receive interest payments of 7% annually on their investment in the fund. Yeah, that's unusual, but hey, there is a lot of unusual stuff going on with SoftBank. Some of this cash to make the interest payments was obtained from selling the stakes in Flipkart and Nvidia, but SoftBank, according to Reuters, had to borrow the rest of the money to fund these interest payments. We'll call this monster the Vision Fund number 1 because now there is Vision Fund number 2. S&P and Moody's both rate SoftBank Group one step into junk. And they have said that they are more likely to downgrade SoftBank than to upgrade it because of its debt. This debt and the credit ratings are important factors because they put a limit on how much the company can borrow to meet its cash needs, such as those for funding the interest payments of the Vision Fund number 1 and to fund the initial payment into the Vision Fund number 2. SoftBank has promised to put $38 billion into the Vision Fund number 2. But where is this money supposed to come from? Other investors have not been gung-ho about the Vision Fund number 2, and no big investor has stepped forward with commitments. Only some small investors have, according to sources that talk to Reuters. The Saudi Public Investment Fund doesn't have that kind of moolah at the moment, sources told Reuters, not until it sells some big assets or until after Aramco's long-delayed IPO, which is still not on the horizon. Abu Dhabi's Mubadala Investment still intends to plow money into the Vision Fund number 2, but is trying to obtain more say in the investments, a source told Reuters. So for now, the fund has just the threadbare pledge from SoftBank to put $38 billion into the Vision Fund number 2, though SoftBank doesn't have the money and may not be able to obtain that money, and everybody knows it. SoftBank is also facing the WeWork fiasco, where it has the choice of throwing several more billions at it to keep WeWork alive long enough for an eventual IPO at a much lower valuation, or let it go to heck, and it's $10 billion along with it. The money SoftBank plowed into Uber may also not be returning anytime soon. So SoftBank Group could try to borrow some more money, but last quarter its operating cash flow was negative. So SoftBank Group could try to borrow more money, but last quarter its operating cash flow was negative, and that doesn't really help a company with $100 billion in debt. While SoftBank had $27 billion in cash at the end of June, it would be needed to pay for its even larger liabilities that are due within a year. Despite the misgivings of S&P and Moody's, the company doesn't see its debt as an issue or as a factor that would limit its borrowing ability. It tells investors that its leverage is actually low based on its quote-unquote loan-to-value ratio, which measures the company's net debt against the quote-unquote value of its investments. This quote-unquote value of its investments that are not publicly traded are in the eye of the beholder, and the beholder is SoftBank. SoftBank uses a leverage ratio that is based on the inflated quote-unquote valuations of its many investments that are not publicly traded, such as WeWork, into which SoftBank and the Vision Fund have plowed $10 billion. WeWork's quote-unquote valuation is still $47 billion, though in reality the company is now fighting for sheer survival, and no one has any idea what it might be worth. Its entire business model has turned out to be just a magnificent cash burn machine. But SoftBank and the Vision Fund have already booked the gains from WeWork's ascent to that $47 billion valuation. How did they get to these gains? In 2016, investors poured money into WeWork by buying shares at a price that gave WeWork a valuation of $17 billion. These deals are negotiated behind closed doors and purposefully leaked to the financial press for effect. In March 2017, SoftBank invested $300 million. In July 2017, WeWork raised another $760 million, now at a valuation of $20 billion. In July 2018, WeWork obtained $3 billion in funding from SoftBank, and in January 2019, SoftBank invested another $2 billion in WeWork, now at a valuation that had been pumped up to $47 billion. With this $2 billion investment at a valuation of $47 billion, SoftBank pushed all its prior investments up to the same share price, and thus booked a huge gain, more than doubling the value of its prior investment. Now, I wasn't in the room when this deal was hashed out, but I can imagine what it sounded like, with SoftBank saying, "We want to more than double the value of our prior investments, and we want to pay the maximum possible per share now in order to book this huge gain on our prior investment, which will make us look like geniuses and will allow us to start Vision Fund number 2, and we'll get the Saudis, which also picked up a huge gain, to increase their confidence in us and invest tens of billions of dollars in our Vision Fund number 2. In these investment rounds, the intent is not to buy low in order to sell high. The intent is to buy high and higher at each successive round. This makes everyone look good on paper, and they can book gains. And these higher valuations beget hype, and hype begets the money via an IPO to bail out those investors. And by this method, SoftBank has driven up the quote-unquote value of its investments, which drives down the quote-unquote loan-to-value ratio. But S&P and Moody's caught onto it, and the market too is catching up with SoftBank, as demonstrated by the scuttled WeWork IPO. Due to these valuation gains, negotiated behind closed doors, the profits from SoftBank's Vision Fund and the company's Delta Fund more than tripled to $1.6 billion in the quarter ended December 31st. Those were still the good times, before Uber's disastrous post-IPO performance and before WeWork's downward spiral. In July, SoftBank reported a 62% return on its investment, including management and performance fees. This, too, was before having to grapple with a write-down of its investments in WeWork and Uber. SoftBank has made two phenomenally good investments. The biggest success was the $20 million it invested in Alibaba in 2000. The stake would be worth over $100 billion these days. SoftBank started selling down its stake in 2016, but still owns a large chunk of Alibaba's ADRs that are traded in the United States. And it owns nearly half of Yahoo Japan, which it helped build. Those two enormously successful investments have created an aura of infallibility and guaranteed success that helped the company gather up large piles of money from other investors. But the debacle of WeWork, Uber, and Slack will force the Vision Fund to write down that investment value. And SoftBank's aura of infallibility has been pricked. In addition, the exit doors for investors in cash burn machines with gigantic valuations and no hopes for profits are closing after the WeWork fiasco and the many big IPOs this year whose shares have plunged. SoftBank has been a huge factor in Silicon Valley, San Francisco, and other startup hotspots. Startups spend this money, much of it locally, through office leases, payroll, equipment purchases, and the like. Uber has an outsized footprint in San Francisco's economy. And there are many other investors that have plowed funds into these startups that are now relatively big companies with huge losses. So if SoftBank and its Vision Fund halt investments or slow them to a trickle, it will put a further chill on other investors. SoftBank was the force that drove up the valuations. What happens to these boom and bust economies such as Silicon Valley and San Francisco that have become uniquely dependent on the startup moolah from around the world? Well, that was a rhetorical question. A good example of what happened before was the dot-com bust. And it wasn't pretty. I'm Wolf Richter, the publisher of WOLFSTREET.com. Thank you for listening to the Wolf Street Report.